Good morning, everyone. Uh, Thank you so much for joining us today on a Saturday morning. We really appreciate you joining us on a weekend. It's been 3 years of Riddhi. We thought it's a good time to reflect back and see how the first 3 years of Riddhi as in the PMS avatar have been. What's the current market context? What's happening? And how are we positioning ourselves into this market? How are we behaving? What's our strategy going in? So to begin with, I will invite Sham Shekhar to with his opening remarks. We'll begin the webinar. Sham, over to you.
Can you unmute Ram?
I think I need to be also unmuted on the video, Rajat. He's not done it properly.
Just a second.
Yeah,
Okay.
morning. It's a pleasure to talk to all of you today. I was just thinking about small cap investing last evening when we were discussing these 3 years of Riddhi. It struck me that I have done small cap investing only for 34 years. And most of the time, I only done small cap investing predominantly. My mind went to how investors have viewed small cap in these 34 years. In the early phase of my investing, people used to scorn small cap investing. The only thing that was worth doing in the early 90s was buying the ACCs, levers, and the blue chips, Colgate, and such companies. At any point of time, the mainstream investment world would look down on small cap investing. It was like child's play, or where the people who are not big enough to do the large cap companies would participate. This was the mindset. And this continued throughout the 90s. To my mind, it also continued right up to 2013, when I think there was a bottom, an inflection point. In 2013, some of the CIOs of mutual funds took a contrarian call that they will actually be able to succeed in small cap. That's when they really went aggressively into small cap. You go and see the size of the mutual fund schemes in 2013 in small cap, and you compare them to the current size, it will be very interesting to do that comparison. I think the scale may be even 100 times today in asset size. But that call which the CIOs took was to use the low valuation in small cap prevailing in 2013 to their advantage by launching a product And most of them went for closed-ended products. So they knew that this can be done for 4-5 years, after which it may not be as productive. Because there are cycles in small caps which are quite hard and often brutal. That change in mindset in 2013 was the beginning of the mainstreaming of small cap investing in the Indian mutual fund industry. Even in the PMS world, except for a few, others were all trying to kind of mimic the mainstream mutual fund industry. So coming to small cap in PMS was also not a very easy thing. But all this changed between 2013 and 2018, which I call as the first wave. And again, in the bear market of 2018-19, the second wave was seeded. So 2018-2023 is the second wave. So you had two waves of investing in small cap, which have completely changed the contours and dimensions of small cap investing. Where are we today? Today we are at the other end of the spectrum. I told you in the beginning that people look down on small cap investors and small cap investing for a very, very long time. Today, people look down on anything other than small cap investing. So you come to the other extreme of the spectrum. Having seen both ends of the spectrum, I feel that both are exaggerated positions to take. Both are not validated by reason and more driven by emotion and very strong recency bias. My sense is that small cap investing will always be challenging. And those who take on the challenge in the right manner and in the right spirit will be amply rewarded. That is my sense of what will happen to small cap investing. So when is the best time to be in small cap? The best time to be in small cap or to be very active in small cap is when we have bad times in the market. When you have bad time in small cap, when people are avoiding small cap is the best time. So 2013 was one phase. I don't want to go beyond 10 years because it will be like a history class, but 10 years is reasonable, right? So 2013 was one time and 2018, 19 and 20 was the second. So 2013 and 14, those who invested made money in 16, 17, 18. So look at the cycle, 5 years. Those who started in 2018, 19 and bought again after 2020 COVID crisis made money between 21 and 24. So look at that cycle also. 3 years of 2-3 years of investing, 2-3 years of return. Now, in the case of Riddhi, actually, it kind of started exactly at the time when that return phase happened. So probably it has rode the cycle very comfortably and extremely confidently. But having said that, there will always be a phase when you will have 2-3 years of opportunity to invest. So you will see things change, market lose a little confidence, market become doubtful, and all these things will reflect in the valuation of companies, and that in turn will help you buy at attractive valuations and scale up your small cap portfolio. So during bad times, small cap will probably be the best place to be, which is what my 34-year experience teaches me. And the most key thing is how you manage yourself during drawdowns in your portfolio. There will be drawdowns. No small cap portfolio can be without drawdowns. There will be drawdowns. There will be periods when your portfolio goes down by 20% or sometimes even 30%. But from there, it can go up significantly. And that has been my experience as a small cap investor. And how much it goes up depends upon what you do during those weak phases. I see someone asking, will contra investing in small cap work now? Very, very selectively. The best time to do contra investing in small cap is when the chips are down, when others don't want to invest. When everybody want to invest, going and doing contra investing is a little bit over enthusiastic, I would think. That means you are thinking that you are smarter than the market, which I would not want to do as an investor. So VRDDHI has basically proved what the process can do, what the product philosophy can do. And where is it today? It is waiting for those 2-3 years when we can position ourselves to buy a lot more of new businesses and companies when the market is more tight-fisted in valuations and when the market is less lenient towards companies. So at the time, we can use our framework and our process more effectively to buy better companies. Today, buying better companies can be a bit challenging, which is why we are waiting to invest and taking our own time to scale up these portfolios. So that is where we stand today. Interestingly, I presume I am one of the largest investors in VRDDHI, if not the largest. And in my mind, this is what I am thinking. I am thinking that I should allocate money over the next 2-3 years very, very actively and aggressively so that I would be able to achieve again what I achieved in the first 3 years of VRDDHI in the next cycle. So I am actually positioning myself towards the next cycle. And this is my view as an investor because I wear two hats and my interest is completely aligned with you. And I think that this is the best way to do it in the years to come. Over to you, Rajat and Rohit. I will now
Sure.
end
Thank
my
you.
comment.
Yeah. Thank you so much, Sham. So I think we are facing some technical issues. Let me just try presenting the presentation again. Somehow it's not coming up. Just a second. Uh, is the presentation visible on screen? Okay, looks like there is some issue. Uh, I think we'll have to hold on for a minute. Uh, I'll just request somebody else to present it. There's some issue probably from my end that I'm not able to present. Sorry, everyone. Once again, we are just, I don't know, some technical problem we are facing at the moment in terms of presenting, but very soon we'll be presenting it. Our colleague will be doing it. So just maybe we'll need to stay on hold for another 1 minute.
Hello.
Yeah, Rohit.
Hello, am I audible?
Yeah, Rohit, you are audible.
Okay. I'm just sharing my screen. Sorry guys for the technical issue here. Is my screen visible?
Yes, it's showing up. Yeah, your whole screen is. Yeah, we can see the presentation. Thanks. Okay. So, well, thanks, Rohit. So, beginning with, once again, thank you so much, Sham. We really think, yeah, we are in very different times right now. So, let's begin with the presentation. Moving on to the next slide. So, we'll begin with the first, we'll begin with how the next last 3 years have been since the time we started Vriddhi. Moving on. So the first year when we started out, it was the second wave, actually May 2021, second COVID wave, which was really a lethal one. And then at the same time, we saw all over the globe supply chain tightening and supply chain issues, and which led to inflation. During that time, market started going up, and then suddenly there was a peak, and then market started falling. And the next year market, as you can see, remained range bound, or in fact, it fell from the peak. Small cap index actually fell by almost 33%. Russia-Ukraine war being one of the major triggers there, and the rate hike cycle, which started all over the world. And starting April, May last year was really the time when markets changed the course completely. Probably, rate hike halt was the trigger, and then as we know, the SIP flows have been really strong, and today they stand at the highest ever that India has seen. And in fact, 1 month inflows have been more than the cumulative 3 years of FII inflows into the country. So that's the quantum inflows we are talking about, and it's clearly reflecting in the way markets are behaving. This is the small cap chart, as you can see, which has gone up berserk in the last almost 12, 13 months. Similarly, on the next slide, as we can see, same is the case with BSE 500, and same is the case with Nifty 50. And now comparing Vridhi's NAV with different indices that we have just seen. If we had invested $100 with Vridhi, it has now become 254. And you can see, touchwood, we have been above every other major indices in the markets. Moving on, this is the performance of the fund during different time periods. Uh, we have completed 3 years, so now our since inception returns are slightly more than 3 years, and this is the longest time period in this table. And like always, recommend that one should always look for the longest time period returns, and that's the best way to judge somebody's return. So, moving on to the next slide. This is the performance of Vrithi portfolio companies in the last 1 year. This year, our median sales growth has been almost 11%, and the profit growth has been slightly more than the sales growth, which was just not the case last year in FY23 because of inflationary issues. We were seeing profit growth to be way, way lower than the sales growth. So yes, so let's look at what we said last year, because when we had completed 2 years, we had talked about certain things. And one of the major things, without boring with all the points that we mentioned, just highlighting 3 points here. We said that markets have run up a lot, and we need to temper our expectations. In certain pockets, definitely it's very expensive. Share prices are ahead of their fundamentals. This is what we said last year, and we saw what has really happened in the last 12 months after we said this. So what we said, we really need to now emphasize it even more, probably raise to the 10 or 20 or 30, because the zone that Sham just mentioned, that we are in that zone now, where everybody is probably hating everything but a small cap. So a small cap is the flavor of the season right now, and that is the time we need to be more cautious. So how do we do that? So what is our strategy? We have always emphasized on risk control, and we cannot emphasize it enough. We cannot, you know, uh, we cannot stop reiterating the same thing that risk control is of paramount importance in investing, and more so in small cap investing. So what's the investing rule number one? So protecting your downside. So how do you do that? So, we'll talk about all of that. Let's first hear what the legendary investor had to say on this. I am not sure if I'm not able to hear it. I'm not sure if you were able to hear it, but I'll just say what really happened here. So Warren Buffett is saying that first
First
rule of
rule, and that's
investing
all the
is
rules there
protect.
are. I mean, the first
Okay,
rule in
Rohit, can you
investment is
restart
don't
it?
lose. And the second rule in investment is don't forget the first rule, and that's all the rules there are. I mean, if you buy things for far below what they're worth and you buy a group of them, you basically don't lose money.
So basically, there are only two rules of investing. One is that you don't forget the rule
The
number.
first rule in
One is
investment
that
is
you don't lose money, which is the most simplest of the rule that you can learn. And this is the first thing that we actually learned from our own investors, that our own mentors. First time that we were exposed to investing, and when we really started learning investing. So our mentors taught us, what our mentors really taught us was the basic and the most fundamental rule of investing is don't lose money, protect your downside, because in a rising markets, upside takes care of itself. Moving on to the next slide.
the first rule in investment is don't.
Yeah, next slide. Yeah. So this is basically, everything taken at Vriddhi is taken from the point of view of risk. As we said, because upside takes care of itself, what we really need to take care of is how do we protect downside. So let's dive in. What are the key tenets that help us protect the downside? So this is something which are the basic tenets of our philosophy here, and we have talked about them a number of times in every webinar, every investor communication. We'll show you how each and every parameter stacks up our portfolio. Going to the next slide, you will see that more than 50% of Vriddhi portfolio companies are actually market leaders, which means they are number one. Vriddhi is a small cap product, so good they are still the market leaders. In some cases, very surprisingly, they are market leaders even in global context, because the market is so small. They have found their niches where they can flourish, where they can maintain high margins, because competition is. Similarly, more than 50% of Vriddhi portfolio companies are actually debt free. We are not saying they are debt, they have some debt, or not much debt. We are saying they are debt free, 50% of the companies. So and none of the Vriddhi portfolio companies actually has debt equity of even one time. So every company is below one time debt equity ratio. Then talking about the quality of Vriddhi portfolio, the last 5-year average ROCE has been 20%. So this is one of the most fundamental, I would say, metric of any business that one would go by to really judge whether the business is good or not. How much money does a business returns you on your capital that you have invested? And that's the number that we have for Vriddhi portfolio. Moving on. Uh, yes. So next important parameter that we always look at is entry valuation, something that we will really talk about a lot in today's presentation because of what we just mentioned earlier, that today markets are expensive. However, looking at all the portfolio companies which have done really well for us, which have gone on to become multi-baggers for us. If you see the entry valuations that we have paid for them, they have been really attractive. All the deep cyclical companies that we bought, they were bought at around one-time book value, and all the other sort of companies which were which had growth aspects in them right from day one, and quality cash-rich companies that we bought, they were bought at around 15 times earnings or cash flows. At the same time, what we would like to highlight is that this entry valuations, they are so important that when we conducted an analysis of the multi-bagger returns of the last 10 years, what we saw was that entry valuations contribute to almost one third of the returns that the multi-baggers have had in the last 10 years, which means you need to buy companies in a zone where they are attractively valued. You can't pay up for them, because if you do that, your returns are going to be compromised. And this is exactly the reason you will learn on the new slides, or we'll talk about that in the coming slides, that why we are right now shying away from investing heavily. Moving on. So this slide basically talks about uh, one of the important, I would say, strategy at Vridhi, or one of the most important weapon that we use to ensure that we are not getting carried away, we are not blindly deploying capital and getting swayed by the market momentum. We need to maintain our discipline. And how do you do that? So we have talked about certain aspects of the business that we like to look at in a company and the entry valuations, but ultimately we also need to ensure that all of this ties up with our capital deployment strategy. We cannot deploy capital in one go if market doesn't warrant that. So how do we deploy capital? Through the four live clients examples and then their data, we will show you how Vridhi's capital deployment has changed because market conditions were such. First of all, the most important point that we would begin this slide with is we invest in companies looking at their individual valuations, looking at the valuation of that individual companies. We are not really bothered by where the markets are. We have to find a very good package in the form of good company, balance sheet, management, growth aspects, and all of that. And then you need to club that package with good entry valuations and the importance of that we talked about in the last slide. Once you have that, that's when you go ahead and deploy capital. So starting with the first set of clients in May 2021, when with the PMS was started, you can see that it took us almost a year to deploy capital. However, if we go to the next set of client, uh, May 2022, it took us less than 3 months or almost 3 months that we deployed almost all the capital. So market conditions were such that the companies were also very attractively valued, and we were finding them in at our desired valuations, and we deployed the capital. Similarly, a portfolio which started in May 2023. We are talking about just 14 months back. A portfolio which started in May 2023. Again, we were able to deploy most of the capital within the first 5 months. However, situation changed dramatically, and as you can see, sorry, are you saying something? So, as you can see, situation changed dramatically with a portfolio which started just a few months back, wherein it's been almost 6 months, and we have not, we are really short on ideas right now, which meet our valuation parameter as well. We have a huge pipeline of ideas, and yet huge pipeline of investable ideas, and yet we are not deploying capital because valuation is not in our favor. So what we are doing here is, like we said, we are looking at individual portfolio companies and their value, individual companies and their valuations, and then judging whether we should invest or not, instead of going all in on day one when we receive the capital and completely disregarding the entry valuations of the companies that we invest in and building a portfolio. We do not follow that approach. It's called model portfolio approach, and we don't follow that. We go by individual names, their individual valuations, so that our margin of safety is intact. And you will see that in current times like today, this is exactly how we are approaching. However, this approach has got its own implications. The first one is that, and one of the good ones is that it takes care of the ongoing market context. You saw that in the previous slides that in some cases we were not deploy even in 1 year. It took us almost a year to deploy. In some cases, in a different time period, basically, it took us less than 3 months or 5 months, and we were able to deploy. How? Because in that market context, individual companies were available at very attractive valuations, and that's how uh, we were able to deploy. Another point we would say is that the old ideas which were basically which we were buying for some time and which were part of and which ran up over the last 12 13 months, we didn't buy them in the new portfolios because their valuations were expensive. And what we started making the portfolio, how we really started constructing the portfolio was buying companies which were out of favor. So when we say out of favor, we will spend a few seconds here. Out of favor means companies is good in terms of their balance sheet, management, and everything, but they do not offer probably high growth in the immediate next 4 to 5 quarters. And if that is not the case, market doesn't really like such companies, and they wait for the earnings to return, and that's when they really like to buy such companies. So such companies which are not offering high growth in the immediate few quarters, they become out of favor, and we will show you how this approach really works. So what are we doing today? We are buying out of favor companies, and exactly the same approach that we followed back in 2021 when we were starting out our portfolios. And during that time, there were whatever companies or sectors were out of favor or were offering us good entry valuations, we were buying them. And we are exactly doing the same thing right now. And we have seen time and again, whenever you build a portfolio, you seed a portfolio, it takes almost 3 to 4 years to see the rewards of that portfolio construction. And that's why we always say one needs to have a time period of 4 to 5 years. Yeah, moving on to the next slide. Let's look at, so far we have talked about the Vriddhi portfolio approach and how the strategy that we are deploying and how we have always been more focused around risk rather than return. So this is all theoretical part that we talked about. Now let's look at whether this approach really works or not. So we have shown whether the portfolio Vriddhi has those characteristics or not. Yes, it does have. Now let's look at whether this approach works or not. Moving on. On this slide, what we are essentially doing is we have divided all the Vriddhi clients in different time period depending on when they joined. So beginning with the first cohort, which is 6+ years. So this is the most interesting cohort, I would say, because when we started 6 years back, Vidhi prior to PMS was in a different avatar called advisory model. So that's when these portfolios were started. So we started in November, December 2017. During that time also, we were in a very similar situation like today. Markets were expensive, and we could see that. Uh, what we really did at that point in time was exactly what we are saying or what we are doing right now. We stuck to what we understand, buying good companies at good valuations. And that meant we were not able to deploy all the capital immediately. And it took us again almost a year to deploy capital even back then. However, what is so special about this cohort is immediately after the portfolios construction began or the accounts began or the investing in those accounts began. Starting January 2018, I think 5th or 6th January 2018, that was the time correction began. And that correction, we would emphasize that correction was actually the second worst or second most severe correction that the small cap universe in Indian history has seen. Small cap index corrected by 65% from its peak in that time period. And this correction didn't last for 1 week or 2 week or 2 months or 3 months, which has been the case in the last so many couple of years. This correction lasted for more than 2 years. And yet, we are very proud and we are very thankful to God that what the results that we are seeing in this cohort, we have been able to achieve, beating all sorts of index that lie there. How did that happen? Exactly using the same strategy that we are talking about. So this is exhibit one of whether this approach works or not. We would also emphasize one more thing here. We talked about what we said last year. So what did we say? That we need to be cautious. It's a time to apply some caution because expensive markets are expensive. Now, at that point in time, when we said that we need to be cautious, we didn't say that we need to cash in. We need to cash out, sell everything, and sit on cash. No, that is not the way it works. You need to be in the market to take advantages of the market. You can't be sitting on sidelines and expect that when the right time will come, you will jump in and invest. It never happens. Market timing doesn't work. So we didn't sell out and sat on cash just because we thought markets are expensive. So we have been able to take advantage of rising markets because of that. And this is exactly how it should be. You should be more cautious. You should stick to what works for you. And what you can do is you can add more capital. You can deploy or buy companies when they are falling. Now moving on to the next cohort. Again, this cohort represents uh, basically a time period when immediately after starting these portfolios, markets corrected once again. This was right before COVID, January, February, and March 2020. Four accounts were there, and we saw heavy correction. And yet, you can see this cohort has also done pretty well. Moving to the second exhibit, and again, very important message on this slide coming out is, we have always talked about, uh, you know, today also we talked about risk control, but at the same time, we have talked about how to really judge whether a portfolio is risky or not. And we feel, and we have learned it from our mentors, from reading about legendary investors, what they talk about. you know uh, uh, Strength of a portfolio and the risk control embedded in a portfolio is really seen during bad markets. In a falling market, you see. So in every falling market, if you are able to protect the capital or limit the losses, that's when you have done the job well. That's when you have done the portfolio construction well. Whatever you do today will show up in portfolio later on. So it is the job of portfolio construction that begins today, which will show its rewards 3 4 years 5 years down the line. So that is why today is very important, the way we approach the markets. So on this slide, we can see small cap index corrected by more than 30% three times in the last few years, and every time, touch wood, with the portfolio has been able to outperform. Moving on, another depiction, similar depiction, but on a full year basis, and a very interesting one, because in this time period, which was FY23, uh, NSE small cap index was down actually, and with the portfolios were up. And again, we would say that thanks to the approach that we follow of risk control, and the benefits of conserving capital or limiting the losses during bad times is that the every penny saved during such time actually becomes the bedrock of your outperformance during a good time. So as we will also see in the next slide that uh, on a particular day in a very recent time, which was a very peculiar day, I would say, because market doesn't really fall that much very often. It was one of those days when market fell to the extent which you would not readily see happening every year, in fact. So very one of those very few days, and hence we just thought we'll put that slide as well. And as you can see, Vriddhi portfolios did really well even on that particular day when markets corrected very, very heavily. Uh, Moving on, exhibit 3. So basically here we are showing when we follow this kind of approach, what kind of stocks you end up picking, how do their performance look like when we have invested in them. So again, using the track record of 23 multi-baggers that we have had so far, as you can see, starting with the first metric, balance sheet, when we invested, nine of those companies were actually cash rich. But after our investment, 16 portfolio companies became cash rich, which means they paid off whatever little debt they had. Same is the case with their profit growth and return on capital. Before our investments, both were actually in the vicinity of 15%. And after our investments, profit growth doubled. Same is the case with return on capital, which is quite obvious because your profits are doubling. Moving on. Very another, I would say, interesting slide and something that we have never talked about in any of our previous webinars, and today we touched upon it in one of our previous slides: buying out of favor businesses or out of favor companies or investing in out of favor sectors. So we have talked about some of the companies could be out of favor because of one reason or other, facing supply chain issues, demand slowdown, raw material price increase affecting the margins. It could be anything. However, to get the valuations, entry valuations favorable, you need to hunt in these areas, and you need to wait for the sector or the business to catch up once again the same trajectory it used to be on in some time back. As you can see, we have been able to find such investment opportunities across sectors, be it capital goods or manufacturing. Capital goods, by the way, is not one sector. To say we can easily bucketize it as one sector, but it is not really. These are all sorts of businesses operating in all sorts of industries. So then real estate, dairy sector, IT sector, infrastructure, engineering. So in all these sectors, you can see that these sectors, we have given the time period here during which we were buying these companies. So for example, capital goods from 2018 to 2021, 4 years we were, most of these companies were out of favor, 4 years. And what did we do? If the valuations were in our range, we continued buying them. This is our job. This is what we understand. This is what we have talked about. This is what we did. And you can see handsome rewards of this strategy, going up as high as 15x. And in some cases, we have even exited the ideas because we found the valuations to be really expensive. And yeah, this is another depiction of our approach working out handsomely in our favor. Moving on to the next slide, please. Brief on what has really not worked for us. These are some three companies that we recently exited from our portfolio. You must have seen this action. In all the cases, we gave enough time to these companies. However, we were, for one reason or other, in some cases, there were corporate actions like, not corporate action, but some developments like JM Financial, some regulatory risk playing out against the company. In HOEC, execution failures, they were not able to get the new well up and running. In case of Natco, our thesis actually went completely wrong. Half part of our thesis, rather, I would say, went completely wrong, and half part still played out. However, there is one common theme coming out from this, is that despite going wrong in all the three cases where now we have exited, we are we still didn't lose much money thanks to our conservative approach towards valuation. Also, thanks to the current bull market, that we were still in profits, and in some cases even good profits when we exited despite going wrong. Moving on. So now this is the last part of our presentation. So we'll talk about how, what's the attractiveness of India as a story, and what's the current market context, in the sense that where do we stand in terms of some of the indicators that market shows us. So starting with Indian story, We have, I think, talked about even this, but would still highlight one or two points here. One is that today we are in twin balance sheet surplus situation. 10 years back, India was in a twin balance sheet deficit situation where, banks balance sheet and corporate balance sheet were in trouble. 10 years down the line, today we are in twin balance sheet surplus situation where both balance sheets have been repaired and we are in a very good situation. Capital cycle is turning around after almost a decade. And now the same is basically same is the case with real estate cycle. We'll spend a minute here. Goes through a state upcycle, and whenever real estate is going through a time in any country, economy, the economy goes through or witnesses high growth, and this prosperity there is a uh, level. Individual and expenses. So this is okay, it value chain of building a house. Everybody, construction uh, companies, be it just imagine the things that you use and that now.
Rajat, I think you're breaking up.
My internet connection.
Can you speak now? Your video is also. Maybe you can just switch off your video for a bit. Rajat, you're on mute. Uh,
Can you hear me now?
yeah, much better. Much better.
Okay, okay. Uh, really sorry, not sure what's really happening today. Okay, so basically, India being the brightest spot in the global context, even capital flows should happen in our country from outside India. Moving to the next slide. Next few slides will basically talk about certain indicators which indicate towards the fact that we are in a market which have become expensive. So as you can see, whenever we reach around such levels on this chart, correction happens. Moving to the next slide. Interesting slide. It basically breaks down BSE 500 companies into different buckets as per their valuations, like price to book valuations of greater than 5x or less than 2x and in between. And you can see today, as of today, basically more than 50% of companies are trading at more than 5 times at their book value, and that has never been the case. I hope I'm audible now.
Yeah, you're audible. Yeah.
Okay. Very similar chart to the chart that we saw just now. Again, reaching levels where markets usually start correcting. So moving on. So, given we are talking about these expensive markets and the situation, how are how what is the approach? We have talked about that approach, but what else? What else? And we believe patience is one such rare commodity in such a market, which is not much talked about. Uh, you know, uh, uh, and it is one of the most important virtues of an investor. And if you use it correctly, it can really help you. And we have seen time and again how being patient on the sidelines, ready with your cash to deploy capital really helps you whenever market gives you opportunity. You just need to wait for those moments in individual cases or at the market level. Sometimes markets are doing well, but a company which was expensive suddenly starts falling because of some news around it or some temporary issues or whatever. And but you need to be ready. You need to be ready with your cash and with your homework, and that's when your patience actually pays off. So because current valuations are not offering us enough margin of safety, we are following this approach of waiting on the sidelines with our set of pipeline ready. So cash today actually may look like a drag, but it will become dry powder the instant we see some correction in the markets. And that's how we see cash today. And we are very comfortable sitting on cash if we are not able to find the ideas at our desired valuations. Yeah, we can go to the next slide. So as a result of this, what is really happening with the portfolios which started in the last 12 months is that there is underperformance because we are not fully deploying cash. And also another reason that we are building these portfolios by investing in certain companies, not everywhere, but in definitely in decent part of the portfolio, we're investing in companies which are out of favor. And we have just started building the portfolios. And like we said, it will take some time as usual, as it took with the other portfolios as well when they started 3, 4 years back. It will take time to show its results. However, in the meanwhile, it's a simple math that if you're sitting on cash and if markets are going up, you will underperform. And this is exactly what is happening. But for us, it is not a 12 months or 18 months race that we are following or we are participating in. We are here in a long haul. We are here in a long-term game wherein we want to capitalize on the full cycle, and it takes 4 to 5 years, like we said. So we need to be patient here, and we are sure that this strategy, which is time tested, has worked across cycles, as we have seen right on this. We are seeing right on this slide itself that across time periods, we have been able to outperform, and we believe same which should be the case going in as well. Moving on. So we have talked about expensive markets, and we know that such times, going by history only, such times do not end well. As you can see, with every such peaks after that, market starts falling out. Global financial crisis 2008 to 9, markets fell by NSE small cap index fell by almost 77%, which was the highest or most severe correction of art in the history of the markets. And second was this 2018, 19, 20. That's when Vriddhi portfolio started actually. And we have gone through this correction as well. So we know by experience, such times do not end well. And hence, we are saying time and again, caution is the name of the game right now. We need to apply risk control at, this is the most important time, or the absolute right time to definitely stick to what we have been doing so far. And hence we are not planning to change our strategy at this point in time. We are going to stick to what we have been doing. Moving on. uh, uh, Absolutely final slide now. This is what we are talking on this slide is what is our promise to you, what we have talked about, and what do we expect in return from you. So we have talked about risk control, and we have said time and again, we do not focus on returns. We only focus on risk control because upside takes care of itself. Secondly, process orientation and being disciplined. It is very similar to saying, the gyan that we always receive from everybody, how to reduce weight, how to be healthy. But it becomes very difficult. And how do you do that? You make a process around it. You become, part of a process instead of just one person getting up one day and taking some random decision. So we have formed a process around ourselves, which helps us ensure that an idea goes through and every investment decision goes through multiple filterings, multiple layers. So it's not that mistakes will completely cease to exist. They will still happen, but the impact, full mistakes or the number of mistakes should definitely come down. And that's what we are really banking on when we talk about our process. And this process has sharpened or has strengthened over the years as we have learned from our mistakes in the last, decade, I would say. And then we are continuing with the time tested philosophy, as we said. And yes, it is a marathon and not a sprint. Like we said, we are looking at minimum of 4 to 5 years here. And finally, what we want to promise you is that not just the returns that we are targeting, that we will achieve them or we will endeavor, will give our best to achieve them, but also at the same time, we will take least possible risk for every unit of return that we will make. And how do you measure risk? It's very simple. Go to any down market, any falling times of the market, you just see what really, how did the portfolio behave during such times, and that will tell you the kind of risk that was taken in those portfolios. So this is what we definitely promise you, and this is what we have been promising you, and like we have showed you our portfolio in action, how this approach actually has played out for us. Now, moving to what we really expect from you and what is our ask. We also want you to be aligned with our long-term orientation approach, because unless we have a long-term horizon, in a short term, anything can happen. Markets volatility can actually become your risk if we haven't really timed our horizon right. And secondly, participation during market correction. Well, SIP is the best form of best approach of doing this. And if we can participate during down markets, whenever such is the case, we should do that. One should add money to their portfolios, because if something was selling for 100 rupees, and if now the same thing is selling for 70 rupees, we should buy even more of that, right? But selectively. So yeah, that's the way to go. And we expect that. And a lot of people, a lot of clients we have seen, they continuously add capital, especially when we ask them that, we have an idea or the markets are in such a range that we should invest more, and they have been able to add, and that really adds up to the incremental returns. And finally, and with this I will close the presentation. We need to have realistic expectations from the market. We cannot expect the kind of returns that we are seeing today to continue into the future. This is exactly what we said 1 year back, but since then markets have become even more expensive. So it is even more important today that we emphasize this fact that we should not expect these kind of returns. Rather, we genuinely believe these returns will normalize to a lower number. I repeat, these returns will normalize to a lower number, because right now we are sitting in such a phase of the market where everything is up. So whenever there is some correction, we are bound to see normalization at some lower number. With this, I will just conclude with the next slide, that this is our whole team, and we have 4 products, for 5 active products right now. And with this, we come to the close of the presentation. Thank you so much. And I'm really sorry once again for, I think we've been receiving messages that my voice is breaking up a lot. I'm really sorry, but we hope to make it up during the Q&A session. And we are open for Q&A now. Anybody who has any question and any number of questions, please write to us in the chat box, and we will start answering those questions one by one. Rohit, was my voice still breaking up during the last part of the presentation?
No, not much. I think it was fine. Maybe for a brief
Then-
period. Yeah.
Okay, so beginning with the first question, which is, Will contrarian investing work in small cap now, when the regulator and big discount broker has already cautioned red flags, the froth in the segment? See, we won't, we are not saying we are contrarian for the sake of being contrarian. We are saying that we are looking at certain criteria in any business. If those criteria are getting met, then we go to the last step, which is valuation. And if the valuation is not expensive, then we buy. Now, as it always happens, it's not that it's happening today. It always happens like that. Valuations, most of the time, when everything is so good, how can you get the valuations also right? Or cheap. So usually earning growth prospects in the immediate future are not that bright. And that's probably because of, and you need to judge, and you need to conclude, or come do your analysis properly to conclusively say that the earning growth phase that we are seeing, which is not really bright right now, is temporary. We need to really conclude that. And if it is temporary, then you more often than not, you get the evaluations right. That's the whole approach. Whether it is contrarian or not, it is it is not really what we are really trying to target. What we are really trying to target is the micro aspects: good business, good valuation, and business growth in the, let's say, next 2 3 years. And as you have seen in with the portfolio companies, in almost 23 cases where we have shown the chart, that after our investment, actually portfolio growth, profit growth, as you have seen, was uh, way more than what it was before we invested. So that's our endeavor overall. Rohit, you want to take the next question? SME investing, what's the view on
Yeah,
that?
sure. Uh, First of all, I think thank you everybody for joining in again. Apologies for the technical glitches, and most importantly, thank you for the trust that all of you have placed on us. So SME investing, I think, so there is a need for, if you step back and see what is it that SME markets are trying to solve for, I think there is a definite need that the markets are that segment is trying to solve for, and it's a very good initiative. But as always, markets tend to take everything to the extremes. So there are all kinds of companies that come into that segment, and then obviously, uh, once few people start making money, then it becomes like a mania. And I think most of the things there are like they're priced beyond comprehension at this point of time. But as what our experience has been, that usually there are good companies that eventually move on to main board, and then get to like the main board, and scale up. So our objective is that we want to find those companies which are there, and the best time is when the tide will sort of go away. But the homework has to start from today, and that's what we are doing. We are looking at a lot of companies, but not with any view of taking any sort of calls to invest as such. I mean, if there is something, then as Rajat has mentioned, we focus purely on the individual company. And if we are bottom up, if we find something, we will definitely look at. But in general, it's a space which is very, it's on the other end of the extreme. I mean, if small cap is expensive, then SME is probably beyond expensive at this point of time. So yeah, so that, but again, very interesting space. Some good companies do come into that, and we will keep looking at them. Obviously, uh, some of them may not be possible to invest in the fund because of the liquidity issues, but our endeavor is to find that company, and then we'll try our best to sort of get that into the fund if we can, if there is an opportunity. So that's an opportunity that we are looking at, but we have to be extremely cautious, because if you go wrong there, then there is, I mean, then it's a dead rubber essentially. So next question. addressed to Sham. I don't know if this is, I'm not sure if this is specific to uh, Riddhi regarding the PMS of for NRI. Uh, Maybe I'll come back to this question. I'm not sure. Sham, if you are there, can you see this question from Mr. MS Kirti? I'm not sure if this is if I'm able to understand this question. The next question, were old expensive ideas part of the old portfolio sold as well? Maybe I'll take it and Rajat, you can add. Definitely, yes. I think in FY24, and that is continuing even in FY25, I think we have sold a fair bit. Uh, I think more than 65, 70 crores worth of equity, worth of stock we have sold. And these are all companies which are expensive and where we think that the forward returns from here may not be justified. So we have been selling and recycling that part to the ideas that we find interesting even in this context of the market. So absolutely. I mean, for us, we definitely believe that if something becomes expensive, we have to use that to cash in and produce. Recycle that capital. Yeah. Rajat, you want to add anything?
Yeah, I'll just add something that it's a uniform decision that we take. So, for example, if we are buying an idea today, we'll try to buy that idea all across. But what happens in some accounts, there is not enough cash, let's say the old accounts, and then you are not able to buy it. We reach out to the clients, we tell them that we are buying an idea, and if they have liquidity, they can add. So when we are buying something, we try to buy all across. Similarly, when we are selling something, we are going to obviously sell it all across. We are not going to be selective because that idea has become expensive. It has become expensive for everybody. The other question I think which got missed in between was the view on the sugar sector. I think we have never evaluated this sector. Uh, you know, there are so many businesses to read and so little time. We have never evaluated this sector so far. Maybe one day when we study the sector, we can talk about it.
Next question, if a company selected by you is out of favor with the market currently, how are you sure that it will perform after 2 or 3 quarters? How often do you range? So, uh, so again, very important point which I think Rajat mentioned is we are not contrarian for the sake of being contrarian. I think that's not what uh, our approach is. Uh, and obviously, one is never sure that this will work, right? I think we go by the basic tenets of that business. So, for example, when we were looking at, let's say, capital goods or real estate 3 to 5 years back, I think what our thought process was that these are companies that have survived very tough periods, and their balance sheets have been extremely strong in a time where the external environment was not very good for them. So our thought process was that at some point of time, the external environment does change and will change for them. And these are companies which are inherently very strong in their areas. And if let's say we are wrong that the external environment doesn't change for next, let's say 1, 2 more years, they will be able to survive because their balance sheet will enable them to survive. So that was the broad thesis that we had. Obviously, individual companies, we were looking at individual companies and not really the overall external environment. But the thought is the same still, that I mean, there is nothing that I mean, we keep meeting these companies every quarter. Many of them will do conference calls. If they don't, we probably meet them every 3 to 6 months, and try and understand what the business is doing, how the business is evolving. And we are patient. I mean, if you are wrong, if we think that the business is structurally broken, then we will take a call. But even in the examples of where we went wrong, we gave the business a long rope of almost 3 plus years. Almost all of them we held on for at least 3 years and some even more. So we give the business time because these are not like these are businesses which are inherently strong. So there is that what do you say confidence that the business will do fine if given time. sometimes you have to take a call and say that, okay, my time is up, and you move on. Or sometimes some adverse thing happens, like in the case of JM, some regulatory risks happen, and we said we move on. So when we talk about out of favor businesses, I don't think 2-3 quarters is what we are looking at. If we are lucky, then obviously it can happen very quickly. But sometimes it can take 4, 5, 6 quarters also, and we are absolutely okay to, as in the presentation Rajat mentioned, we bought that whole sector, different companies for almost 16 quarters, right? 2018 to 2021. And some of these decisions were painful, but at that time, but they more than compensated for that pain. And it's not that we want to take pain by design. It's just the process that if you are finding companies which are fundamentally strong, then eventually they do work out. Anything else, Rajat, you want to add?
Just one small thing, that it's the at the end of the day, it's the we need to look at this at the portfolio level, and endeavor should be, if we are wrong, we shouldn't lose much, and if we are right, we should make decent amount of money, at least in one or two of them, which ultimately results in alpha generation. And luckily, touchwood, so far that has been the case.
Next is an interesting question. How does a day in the life of co-fund look like? Uh, so mostly, uh, it's mostly time spent reading and talking to people. That's how I would sort of bucket reading transcripts of conference calls, listening to them, reading annual reports, exchanging ideas with peers and friends, and talking to management. So this is broadly the day that you would look at. The way we are both, and obviously I will include Sham also in this, that broadly the way we think about markets is, and the way we think about investing is very, very similar. I mean, you can pick any product of iThought. I think the way we think about risk is very similar, whether it is solitaire, whether it is Riddhi, whether it is even Sphere. I think so that is very ingrained. So we converge on that completely. I think there are some sectors that I look at which Rajat does not, and similarly the vice versa. So apart from that, I think we are fairly on the same page on almost everything. Rajat, you want to add anything?
Yeah, so maybe I can just quantify some of the things that you mentioned. For example, every quarter we'll go through almost 100 conference calls individually, and then maybe 20, 30 management meetings almost every quarter, where, either some conferences are happening or we are doing one-on-one meetings with the management teams. Now it is the AGM season going on. A lot of annual reports are coming out. So endeavor will be to read as many annual reports as we can. And these things that we just talked about, conference calls or annual reports, have been one of the important source of our idea generation. And some of these talks that we have presented in some of the slides, which have been our multi-baggers, were actually found that way. So yes, we continue to devote as much time to reading about and enhancing our area of knowledge, wherein we understand more and more businesses, more and more sectors, uh, you know and it is an investing what really happens is that it's not like you pick up a company afresh today and you invest it in that tomorrow or the next month. It's been many years that we are in the markets, and some of the companies that we invest, actually we have been tracking those companies for over 5 years. And after 4 or 5 years, we are investing in them. In most of the cases, we are at least studying or devoting some time to that sector or the business for at least 1 year in most of the cases. So this is what our regular day will look like, that you have to read up a lot, and then like Rohit mentioned, we end up speaking to fellow investors, and Rohit and I discuss a lot. Yeah.
So next question is a very good question, is like, how do we think about selling in our portfolio, and how do we think about selling our winners? So I'll bucket probably selling in two parts: one where we are wrong, and one where uh, 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 where things have worked out, and we have to sort of think about uh, where to sort of take a call on exiting, etc. So where we are wrong, I think when we realize we are fully wrong, I think we exit, and we give, as I said, we give a long rope on the business to revive, because fundamentally businesses that we pick are decent businesses. Now coming to the part of how to sell winners, I think it's an evolving question for us also, and there is no silver bullet. We've been wrong couple of times, and we've been successful couple of times. But I think what our thought process is that uh, we sort of look at the forward returns 2 years, 3 years hence from where we are. And if we see that those returns are not uh, good for us to hold on, then we exit. Also, there is no, very rarely have we exited at everything at a single point of time. We sort of start exiting in piecemeal basis, and then that also enables us to ride our winners better, versus earlier we used to just sell at a certain valuation, which I think we have evolved from there. We do understand sometimes that when we sell from there also, the price will, the stock can do well, and that's okay, but we have to take our call. And but some things, when they get egregiously priced, you have to take a call, is where we are. So yeah, that's what I would say. Rajat, you want to add?
No, nothing to add here.
Which sectors are currently out of favor? Not many. So media is one, agrochemicals, chemicals, maybe these are a couple of sectors which I can think of. Consumer durables maybe, but yeah, again, valuations they're also not very cheap. But yeah, these are three, four sectors. Rajat, you want to add anything?
Uh, no, actually, instead of saying that sectors as a whole, but I think there are few businesses, few pockets of opportunities wherein you will say a certain business facing some, problem for one reason or other. That is how I would say that this is how, apart from few sectors that Rohit mentioned, otherwise, all in all, in totality, I think there are very few opportunities available right now. Even some of the out of favor businesses are also expensive.
Yeah. Yeah. The next question is it a good time to enter into Vridhi later? See, I think it all is a question of horizon, right? I think if we are looking at 4, 5 years, then given the way we invest, we're not going to invest everything on day one. We are not having that pressure. So we will follow that process. So if that is the case, then probably if you are okay with having that 5 year view, then all these things, these periods of market being very high, and then obviously correction, all these will equalize, as what was shown that over 6 plus years we've done fairly well, and both absolute and relative. So I think it is a question of asking yourself very seriously, will you be okay? What is really one's horizon? There could be a possibility, and which is already sort of played out. People who've been with us for the last 6, 7, 8, 10 months, we've not outperformed, or we've trailed the benchmark or the small cap index, because we are we are being cautious, and sometimes that takes a that markets take caution to the wind, and they're just risk on mode is on. So if one is okay with those things, then any time is a good time, I would say. So, but yeah, it's an individual call that one has to take, because we will keep finding ideas. At every point in time, we have seen that we'll be able to find ideas, but to create a portfolio with, let's say, 15, 20, 25 names, it will take time. And that is what we are doing. Anything, Rajat, you want to add?
No, we are good.
So the cash that we have, we basically invest in liquid Bs, and the returns that are shown these are all after all the fees and charges, etc. I think we have spoken about SME investing. Uh, So, what are the realistic expectation range that we have to uh, uh, so I think, see, broadly, I don't know how I will not answer this in a numerical way because I don't have a good answer there. But in the sense that, see, over the long term, over a cycle, all the indices, whether they are Nifty 50, Nifty small cap, mid cap, all these broad market indices, they're all pretty much around the same returns. You can check this data. Uh, uh, Maybe 100 basis points here or there. So, and the reason for this is obviously that the small cap, the drawdowns are really, really bad, as was shown by Rajat in the presentation. 50, 60, 70% drawdowns is not out of the ordinary. So, whatever obnoxious gains that are there, they are given up when the market goes down, right? So hence the overall picture remains similar. So I think if we are able to do well post fees by 200, 300 basis points, we should be fine. I think that's what our expectation and our endeavor is. Uh, that turns out to be 17, 18% or maybe 20% post fees annualized over a cycle. We will be happy with that. Obviously, that numbers seems very low to people today because that seems like a given, but there is nothing given in the markets. We all should understand that making money is never easy, and if it was easy, then there is some catch, right? So, from first principle basis, money making whenever it is easy, we have to be cautious. So it's like driving, right? So people can drive around us very crazily, and we have to ensure that we don't drive and we don't get hit. So that's where we are, and this can continue for next 12 months, 18 months. So and or even more. We don't know all these things, but we have to be sane at this point of time. So I don't know whether I answered your question, but I mean, like a business earns 22% after doing so much of work in terms of its return on capital. And here we want, as passive investors, to earn 35, 40, 50% returns in the markets. Now, why should it be there and how can you do it? Right. I mean, that's all I would say. Rajat, if you want to add anything.
Just remember one anecdotally, one incident. Uh, when we started in 2017, right at the peak of the markets, people would say 15-20% return is not that big a deal. 15-20% returns is not that big a deal. Uh, One should aim for higher you are in small cap, and markets are doing so well. Why don't you, if you don't make 25%, what's the use? And yet we would say, I mean, like what Rohit just said. However, when 1-2 years down the line, 2018 and 19, we saw one of the second most severe correction. The clients would come back and say, our expectations are only 10 to 12%. That's how it has happened with us. Some of the people we have been in regular touch with, they have explicitly changed their expectations as per the markets. But this is not how it should work. We are here for the long haul. For we say a minimum of 4 or 5 years, and we have seen so many of our clients being there for more than 6 years now. So we are here for the long haul, and as you elongate the time period, even 15-17% kind of returns generate immense, I would say, wealth effect, as because it's all compounding that is happening. Yeah.
So reason for a comparatively higher churn. I think it's all in, say, I think one, at an absolute level, the churn rates are not very high. Last I checked, they are about 20-25%, which means our holding period is 4 to 5 years. And it's a function of two, three things. One, obviously, valuations have run ahead of some for some companies, and we are just sort of using that to our advantage at this point of time. So in markets, there is bunching up of bunching up happens. So many ideas become overvalued. So we are taking that call and executing. So hence at an aggregate level, the churn may look higher, but uh, I would just say that very low number of ideas where we would have exited within the first year. That is something that we would. I mean, I don't think we have done, barring one case in the last 3 years. And I think that is something that we would continue to do more or less. But yeah, I think, yeah, maybe churn has gone up slightly from let's say last year, because we have been selling a few things because of valuations.
Yeah,
Anything, Rajat?
actually, yeah, actually, last 1 year may not be the right time uh, because this churn ratio is last 12 months, right? So
Yeah.
markets are so expensive. Whatever mistakes you have done, it's the best time to get out. Wherever you have seen stocks rising up beyond what they deserve, it's time to get out. So automatically this number is going to look high. Let's go back to FY23 end. Our churn was less than 6% actually back then. And this is what you would, I won't say that 5-6% is the norm, but a lower number, much lower than what we see today, because we have actually gotten out of a few ideas which we thought were a mistake, and where we have, and some ideas where we have exited because valuations have run ahead of the time, and that will not be, and that is not a bad churn. Churn itself is not a bad idea.
Yeah.
It's not a bad churn at the end of the day. Somebody said, you know it goes in Hindi like this: पैसा invest करने से नहीं बेचने से बनता है. So you have to sell also at some point in time if you think valuations are ahead of the fundamentals. So this is a good churn. you know at some point in time you have to capitalize on the profits if you think next 3-4 years are already discounted.
Yeah. Thank you. So, the next question, yeah, Satish. I think this is also answered in the sense that we are using this time to. I Rajat answered this question. Also, as a someone, if a new investor joins Ruti but unable to add incremental money for whatever would there be a scenario. Uh, see, I think, see, our we would love that if the investor adds money, because see, at any point in time we will be adding new ideas, and we will not sell something just to accommodate a new idea. We will sell something when that merits a sell. So, and then whatever capital has been generated or has been generated from that sell will be recycled into whatever new idea that we are buying. But yeah, I mean, it's not that we don't prefer to add investors who will not add, but I mean, ultimately, it's like gardening, right? You have to sort of water the plants for them to grow. So we would want that this like the attention that we are giving you also, if you can add some portion, maybe not regularly, but at least in some intervals, if you can add. Theoretically, it's a possibility that that portfolio may underperform. We don't know. I mean, there are various scenarios that can happen, but what may happen is that we may not be able to buy all the ideas that we want to, but that we may be buying in another portfolio where capital keeps coming. Rajat, you want to add anything in this?
No, nothing to add. We can move on. I
Okay.
think next we have already talked about the selling discipline. I think we are very clear that we want to sell wherever we feel valuations have run ahead of the fundamentals.
Yeah. I think there was a question on a business. Uh, I don't want to talk about very specific companies here, but it's an interesting business that we have, that we feel, and it's not something that we are looking at next 12 months or 6 months or something like that. I think they are trying to build something, and they have some competitive advantages. Let's see if they are able to execute. Uh, we'll get this slide. We'll get this slide sent to you about the comparison between us and the mutual fund. If
Would just request to drop in, drop in an email, right? Or because we don't have the, yeah, please drop us an email. You have our email ID, pms@ithought.co.in, and we'll share the slide. Anyways, this presentation as well as the video will be available on YouTube after a couple of days.
So Natco, because you exited, they are north of 20. See, I think again, Natco, I mean, while we bought it in the PMS in 21, we've been holding the stock since 2019, or 2019. So it's been more than 5 years. I think it's just a question of us thinking that maybe we have better ideas. And honestly, that is a business and a management that we still like. Just a question of us not being able to uh, put our arms around the next 3 years post FY25. And there could be anything, right? I mean, the way the markets, see, we thought the profits, what we thought in terms of profits for Revlimid, the company has actually done better than that, honestly. And this is despite the base business eroding. So they actually did much better despite a handicap. However, the markets have not really valued those profits, rightly or wrongly. Let's not get into that because markets are supreme. So we have just taken that call and sort of taken that feedback and moved ahead. Now, let's say, so they don't have uh, anything in the anvil for the next 3 years. Everything starts from FY29 or FY30, from an earnings point of view. But can the markets take an opposite view that okay, now the earnings will come in FY29, 30, but the markets will redate them earlier? It can happen, and we have taken that call that we don't want to take that risk and purely based it on the hope that the markets will redate them and just buy it, because earnings growth will not be there post FY25 or 26 maybe. Uh, so we have taken that call and moved on. But it's not an early exit actually, that's what I'm trying to say. We've been holding it for 5 years or more. It's just a question of we feeling that there could be better opportunities where we are more clear what the earnings growth could be. Here we are not sure what the earnings growth could be beyond next 1 year. Anything to add, Rajat?
No, nothing really.
Uh,
I fear when new government form will have no threat for 2-3 years, so market seems to grow ahead. Well, I think it's all about the process. It's all about the uh, you know philosophy and what has worked for us and what has really worked for us is something that we have talked about in this whole presentation. And one of them being, and why we are not really investing heavily today, is being valuations, and they're not in our favor. Like we have said this time and again, data is also not in the favor of buying companies without any regards to the valuation. Data is very clear, and data is data. It's a fact. It has happened, so we can't dispute that. And data says, we have said this in the presentation, so we are repeating it, that 1/3 of the returns of the multi-baggers in the last 10 years actually came because stocks were re-rated to higher valuations. And re-rating usually will happen when you are buying at attractive levels, not at when you're buying already at expensive levels. So to tilt the odds in your favor, you have to do this. And you cannot or you should not change this just because markets are in a different terrain right now. We have seen cycles repeating time and again in the last 14 years of our existence in this investment business. We have been also tempted many times when we were starting out, that we should also do this or that, but ultimately we have to go back to rule number one, that we need to protect the capital. We need to take or ensure that our downside is protected. And you know you have to take the decisions keeping in mind not what will happen in next 2 months, but keeping in mind what can go wrong in next 3 to 4 years. You don't want to be sitting with an idea where you just about thinking it will do well. You have to see everything that has to be in your favor. All the things that we talked about, including valuations. If they are not in your favor, and if you go wrong, then the seeds of underperformance, you know, is something that we are sowing today by not being disciplined. So we want to be disciplined, and we want to sow the right kind of seeds so that we have the right kind of tree as well after 3 4 years.
Also, I
Anything you
think we
want to
are,
add, Rohit?
yeah, no, I think we are, it's not that we are fearful or, see, I think we are deploying capital, we are buying new ideas as well. It's just that our asking rate or our uh, benchmarks or whatever you want to call it, we are setting a high bar for them because at this point of time, because of the fact that, as I said, in general, many people have made returns. It generally gets, people don't follow the process, and it's just that, oh, there is a very good saying that don't confuse brains for bull market. So I mean, we just want to follow that process of just being very prudent. And sometimes prudence, if you're driving at 120, the chances of you having an accident is more, let's say, versus you driving at 60. You will get eventually, sometimes 120, you can get to this destination faster, but at 60 also you'll eventually get. But the risk of 120 having an accident you'll only know that when you go through an accident, right? So we don't want to go through an accident. That's all. So uh, yeah. No, I think it's not a question of, see, it's, I mean, people with lesser portfolio sizes will sit on. See, again, we are not taking a call on the markets, right? We are taking a call on the fact that whether this business that we want to, at an absolute level, we want to buy certain kinds of businesses at certain kinds of prices. When that convergence happens, we will buy. Whether the market today is at whatever 75,000 Sensex levels or 77,000 Sensex levels or 1 lakh Sensex levels or 50,000 Sensex levels or whatever levels of small cap indices are. It's not so much that we are looking at a certain level and only then we will enter. We are evaluating many businesses. We have many businesses in the pipeline which are there in the watch list. We will sort of keep we are having a close watch. The last probably between April, May, between March, April, and May, there was a brief period and we increased our allocation, and that extended to some days in June as well. So it's not that we have initiated new ideas, and it's a process. So yeah, I think that's all I will say. We don't have any target to sit at a certain cash or certain cash below. It's all going bottom up, and whatever the outcome is that. There is no premeditated view that we have to keep a certain cash because the markets are at certain level. No, I don't think that is how we work. I think we've answered all questions. Maybe we'll wait for another minute or so if there are any more questions. I think we have answered all the queries. Uh, so again, thank you very much for your patience, and once again, apologies for the glitch in the beginning. And thank you for your patience and thank you for all your trust. If there are any other further questions that you have, you can always reach out to either of us, or you can email us at pms@ithought.co.in, and we'll be happy to engage and answer and have a discussion. But yeah, I mean, this is all for now, I think. Hope to have an interaction again soon. Thank you very much.
Thanks, everyone. Have a good
Thank
weekend.
you.